Welcome to Modern Wall Street. Today we have a very special guest, lawyer and best-selling author, Jim Rickards. And guys, if you haven't had a chance to pick up one of Jim's books, I highly recommend it. I just finished up Currency Wars. I'm in the middle of his newest one, A Road to Ruin. But the best part is we have Jim right here in person to talk to. So let me introduce you to him and Jim to the show. Hey, Jim, welcome.
Great, Buzz. Great to be with you. Beautiful day on Wall Street.
Isn't it, though? Well, thank you so much. I'm sure our viewers have a better understanding of you about what you're about right now, considering your most recent book is titled A Road to Ruin. Now, are you suggesting there's this inevitable catastrophe that we're going to be in for, or is it the way we're structured that can allow a problem to exacerbate to a major one?
Well, both things are true. It's the way we're structured and the risk in the system that will lead to a catastrophe. By the way, Buzz, I would distinguish between a financial panic such as we had in 2008 and also 1998 and a normal business cycle. Right now I think we're more vulnerable to a business cycle. I think we're heading into a recession. But let's just talk about the crisis situation. In my book, The Road to Ruin, I look at two prior crises, 1998 and 2008. Both times we came within hours or days from the complete collapse of the financial system. Not an exaggeration. 1998 was long-term capital management. I negotiated that bailout. 2008, I think that story is very well known. We all know what happened there. Bear Stearns failed in March '08. Lehman Brothers failed in September of '08. Fannie and Freddie failed in June of '08. We were just days away. Morgan Stanley would have failed, then Goldman, then Citi, then the entire rest of the dominoes would have fallen. That didn't happen because the Fed intervened to the tune of tens of trillions of dollars. But here's the point I make in the book. 1998, Wall Street got together and bailed out a hedge fund. 2008, the central banks got together and bailed out Wall Street. In the next crisis, who's going to bail out the central banks? In other words, each crisis gets bigger than the one before. Each bailout gets bigger than the one before. We're now at the point where we've exceeded the capacity of the central banks to save the day. So when the second crisis hits, which they always do, I mean, they come along every 7, 8, 9 years, almost like clockwork, where's the money going to come from? Where's the Fed balance sheet expanded from $800 billion to $4 trillion to deal with the last crisis. The problem is they never normalized. They're still at $4 trillion. So what are they going to do in the next crisis? Go to $8 trillion, $12 trillion? What's the limit? And there is an invisible confidence boundary that they will cross, and they know it. That's why the Fed's talking about trying to get back down to maybe $1 trillion. Of course, that'll take them 10 years. They know that. So they're not prepared for the next crisis right now. So where's the money going to come from if you have to reliquefy the system? It has to come from the IMF, the International Monetary Fund. They have the only clean balance sheet left. So you're talking about trillions of special drawing rights, this world money that they print, these SDRs. So I know these sound like extreme outcomes, but they're actually very predictable based on the models and complexity theory.
Yes, and you don't just use history to back up your claims. You use psychology, physics, and the complexity theory. How should we be using these tools in everyday finance?
Well, we should be combining them. Complexity theory is a really good way to understand systemic risk. So the metaphor I use, but it's more than a metaphor. So you're in the mountains, it's snowing, snow is building up on the mountainside. Any seasoned hand can look at it and say, there's going to be an avalanche. It's windswept, it's unstable, etc. So one snowflake comes along, it disturbs a few other snowflakes, hits the wrong way, creates some momentum. All of a sudden, the whole mountain rips loose and kills the skiers in the village below. Who do you blame? The instability of the snowpack or the individual snowflake? Well, if it wasn't one snowflake, it would be another. So it's really the instability of the system. You can measure that in financial markets using what scientists call scale. So the gross notional value of derivatives, what's how big are the 5 biggest banks? What percentage of the total banking assets do they own? What's the degree of interconnectedness? There are many, many metrics like that you can use. So everything that was too big to fail in 2008 is bigger today, which means the system's more vulnerable. All this stuff about bank capital. Look, if times are good, you don't need any bank capital, and if times are bad, no amount is enough. So bank capital is not going to save us. Stress tests, I've spoken to Secretary Geithner and Ben Bernanke about this. I mean, they talk a good game, and I respect them, but this stuff is not going to work in a crisis. So the whole system's going to come tumbling down. The question is, what's the snowflake? Could be almost anything.
Oh, very intriguing. And yes, that was my next question. Should the central bankers be using these methods towards monetary policy? I mean, the Fed just announced they are to shrink their balance sheet. Do you give them props for that at all?
Well, I wish they'd done it 8 years ago. I mean, the thing is, they should have creating liquidity to deal with the crisis in 2008, which is what they did. That's what they were supposed to do. So QE1, I'll give them a pass on that because the system really was melting down. They really did need the money. QE2 and QE3 were just experiments by Ben Bernanke, and I've spoken to Bernanke about this. That's his word, not mine. He said, these were experiments. He said, 30 years from now, some future young scholar, some future Ben Bernanke will look back and tell us if we did a good job. I'm like, thanks, Ben. So we're guinea pigs in your monetary experiment. We have no idea if it worked or not. Actually, it's not working. We never got the growth. The Fed never, in 2009 and 2010, when they set out on QE2, they never thought we would be in 2017 with a $4 trillion balance sheet, less than 1% growth. They never thought we would be here, but here we are. And then now Yellen's challenge is how do you get out. Now, I'll give her props for starting the process. Thank you, Janet. But should have done this 7 or 8 years ago. And by the way, we're going to be in the next recession probably by summer, if not a financial panic. You can't forecast. Well, here's what you can say about financial panics. You can say they're definitely coming, and you can estimate how big they'll be, and the next one will be the biggest in history. You can never get the timing right because this, again, which snowflake is going to start it. Business cycles are different than panics. We're heading into a cyclical recession right now, in the middle of a depression. But we've been in a depression since 2007. That's what 2% growth is. When your potential is 3.5, and you have 2% growth, that depressed growth, that output gap, that's what a depression is. But you can have recessions, technical recessions, in a depression. That's what we had in the 1930s. There were 2 recessions, 1929 to 1933 and 1937 to 1938, but the entire period from 1929 to 1940 was just one big fat depression. So we're in a depression now, kind of like Japan has been in since 1990. The question is, when does the panic come? It could be any day.
Well, let's stick with the central banks, considering that they are major players in currency wars. Now, we've had a few currency wars over the past decades. We are currently in one. However, President Trump announced yesterday that he doesn't deem China as a currency manipulator anymore. So they were our biggest opponents. So did that change things up? Is the currency war over?
It's not over. And you say we've been in several currency wars. You're right, Vaz. That's the way it gets reported. I would say we've been in one big currency war since 2010 with battles. So you take a real war, World War II, it's not all fighting all the time. So you have the Battle of Stalingrad, you have D-Day, you have the Battle of the Bulge, and then there are quiet periods also. So that's the way the currency wars are. This is just one long currency war, which is what I said in my first book, Currency Wars. I said they can last for 10 or 15 years. But yeah, sometimes it gets more intense. You have these battles. Now, what Trump's doing, look, Trump's the art of the deal. So when he campaigned, he said, China is a currency manipulator. On my first day in office, when I'm sworn in, I'm going to sign an order labeling them a currency manipulator, which you can't do, by the way. It's up to the Treasury. It's a separate thing. Treasury report's coming out in a couple of days. Anyway, they've made it clear that they're not going to label China a currency manipulator. Nothing changed on the facts. Nothing changed. What changed was that Trump, that was a bargaining chip for him to get Chinese help on North Korea, because we're heading for war with North Korea. And the Chinese did help. They mobilized the People's Liberation Army, put them on the Yalu River, which is the border. They said no more coal exports from North Korea. It's one of the big sources of foreign currency, other than selling weapons to Iran for gold, separate issue. So China's helping a little bit, so Trump's giving them a break. Trump he's situational, he's mercurial. He's actually not that hard to predict, in the sense you can predict the unpredictable. He'll just do whatever works. He's always looking for leverage. That was his comment, in the Wall Street Journal yesterday. Because on the campaign trail, he said Janet Yellen's toast, right? Yes. So the reporter said, "Is Janet Yellen toast?" He goes, "No, not toast." In other words, Trump's always looking for leverage. Right now, he does not want the Fed to raise rates, because it'll slow the economy. And he's right about that. The Fed is going to raise rates because they have bad models. They can't see the recession coming. And so Trump says, well, what's my leverage on Janet Yellen? Well, the leverage is her job. She's up for reappointment in January. So by saying, you're not toast, he's saying, well, I might reappoint you if you're on your best behavior. Best behavior defined as don't raise rates. Well, along comes the godfather, Bob Rubin, who we haven't heard much from. He's the most powerful figure in finance behind the scenes. He doesn't come out to play much, but he came out yesterday with an op-ed just saying to Trump, don't play politics with the Fed, which is nonsense, because the Fed is completely political, but Rubin wants to pretend otherwise. So there's this struggle going on for the soul of the Fed. Trump's going to have 5 seats in the next year. Trump owns the Federal Reserve. He's going to get whatever he wants. So there's an interesting struggle going on.
Yes, absolutely. Now, Jim, since we are still in a currency war, how could we follow along, or this looming financial crisis? Can we take a look at the markets to show us any signs or any economic data points to tell us who's winning or what's going on?
Well, you don't usually get very much heads up on a panic, although interestingly, again, the 2 cases I talk about in my book, The Road to Ruin, 1998 and 2008, they both started over a year earlier. So 1998 came to a head in September 29th. 1998, we were just hours away from closing every market in the world. But that started in June 1997 in Thailand when they broke the peg with the dollar, started a panic in Asia. It went to Indonesia, Malaysia, Korea, calmed down a little bit, then reemerged with Russia, and then hit long-term capital management. So it took over a year to play out. Same thing in 2008. Now, the fever pitch was September 15th, 2008, when Lehman Brothers filed for bankruptcy in those 2 weeks up until early October. But that started really in the spring of 2007. HSBC warned about mortgage losses, and then the two Bear Stearns hedge funds failed. Bear Stearns itself failed in March 08, but the two hedge funds failed in July 07. And then you had, Jim Cramer's famous rant to Aaron Burnett, they know nothing, So anyway, but the point is, both of those took over a year to play out. So the next one may be faster, but we'll get some warning. I don't see the dangers there. I don't see that panic starting yet, but I'm obviously watching for that. But what I do see is a normal business cycle, again, different from a panic. We're heading straight to a recession. The Fed is going to drive the last nail in the coffin of the U.S. economy with a June rate hike.
All right, Jim, I know we're running out of time, but I have to ask a man like you. Do you have any positive news for us? Or, even better, instead of a pep talk, can you give us a prep talk?
First thing is have 10% of your investable assets in gold. When I say investable assets, take your home equity and your business equity, you're a car dealer, pizza, whatever. Put that to one side. Whatever's left of your investable assets, put 10% in physical gold. I don't recommend paper gold. They trade GLD ETFs right here on the New York Stock Exchange. That's good for short-term price exposure, but that's not going to save you in a panic. So get physical gold, just 10%. People think I say, sell everything and buy gold. I've never said that. I like a 10% slice. I like real estate. I like cash. People are surprised to hear me say that. They go, hey, Jim, you're the guy talking about the death of money. Why would you have cash? The answer is I might not have it for long, but I like it in the short run. It gives you optionality. You can pivot depending on, because inflation and deflation are both in play. So the person with cash can be nimble, let's put it that way.
All right, great. Well, it looks like I'm 1% on my way to 10% gold allocation. Jim, it was a pleasure to meet you. Thanks so much for coming on the show.
Thank you, Voz.